Welcome to this episode of the Note Closure Show. As always, Scott Carson, excited to be here with you today on this episode. And today's episode is sponsored by somebody who reached out to me and was asking me a bunch of kind of weird off the wall questions. And I was like, he was literally like reading from a script. And I asked him, I said, okay, what are you reading? These questions don't seem to build upon each other. And I've been around long enough so that when I give you the answer to one thing, it should lead to another question, not the ones you're asking me. And the guy goes, well, I'm learning. I asked all these questions of AI. I'm going to learn via YouTube and AI. And I'm like, well, that's not going to lead you in a very good path. He goes, why not? I said, because AI is not accurate. Yes, it's good about 50, 60% of the time in a lot of cases, but it's very high level, very kind of generic, don't want to offend anybody, very high level stuff. Doesn't give you a lot of the nitty gritty that you really need to be successful. Yeah, if you want to take everything AI throws at you or doesn't throw at you and you just ignore it, by all means, go right ahead and I'll see you later at the foreclosure block. Okay. So I thought I would do this episode just to share with you guys. And honestly, if you're experienced, you're going to want to sit around and listen to some of these answers because I just literally went and asked a question and then it spit answer out to me. And I went back, okay, I left it like that. And then I added my aspect of it. But it's important, especially if you're brand new, you may be doing the same thing and just taking it at its word when it's completely off in a lot of cases. It doesn't even mention some of the other things when it comes to note investing. Okay, so today's topic, like I said, 20 most questions asked about note investing, the AI edition. Now, what AI did I use? I used Google's version, Bard, B-A-R-D. Gemini is called that sometimes as well, too. And I like that because it's a little bit more up to date than ChatGPT. I've been using this for a while. Don't worry, you could probably ask the same questions to ChatGPT and it would do the same thing. Now, I originally went and said, give me the 50 most asked questions. And it got really granular, which is better. But about half of those questions still had missing pieces or things that would put you down the wrong path in a lot of cases, or you wouldn't know to ask because you just trusted Bard. This is why it's important to have a coach or somebody who's closed on thousands of deals and helped thousands of other note investors take their real estate investing to the next level and by hiring a coach. But anyway, if you want to roll that Russian roulette of dealing with Bard, by all means, go right ahead. So exactly what did I ask? And you can do the same thing. What are the 20 most frequently asked questions about note investing? And like I said, it may be a good starting point, but it isn't 100% accurate, and you'll see why. All right, so we'll go through each question with AI's answer, and then I'll throw in my answers to it as well. So it's something for you to keep in mind. Yeah, not too long, so probably 30 minutes. So the first question is, what is note investing? And it gave a pretty good answer to it. Note investing, also known as mortgage note investing, involves purchasing real estate debt, promissory notes, secured by a physical property. Here's a deeper explanation. The promissory note, this is a legal document outlining the terms of the loan, including the principal amount, the interest rate, the repayment schedule, and borrower obligations. Correct? The real estate debt. When someone takes out a mortgage to purchase a property, they create a debt obligation to the lender. In note investing, you are essentially buying this debt from the original lender. Yes, you're not buying the property. You're buying the debt from the original lender or a lender, because that note may have been sold a couple times, and you have all the same rights that the bank does. And it's secured by a property. The promissory note is secured by the underlying real estate property. This means if the borrower defaults the loan or stops making payments, you as a note holder or the lender or the bank have the right to foreclose on the property to recoup your investment. Now, there's other exit strategies along the way. Essentially, I wanted to be clear. Now, you become the new lender. You collect the mortgage payments from the borrower and earn a return on your investment through the interest paid on the note for the lifetime of the note. Okay? So not too bad there. Way to go. Get the basic one right there. Okay? How much money do I need to start note investing? This is a question I get very often from people. There's no one-size-fits-all answer, but note investing can be started with a lower barrier to entry compared to directly buying real estate. That is correct. Minimum investment amounts can vary depending on the platform or broker you use. Some require as low as $5,000 to $10,000, while others might have higher minimums. It's important to consider the cost of the note itself, potential closing fees, and any ongoing servicing costs. That's correct. Now, yes, you can buy notes for 5 or 10 grand. Yes, you can buy small notes and stuff like that all the time. Okay. You're going to need besides using your own money in some cases. If you don't have any of your own money, that's okay. Just go raise some money. All right. And that's a whole different ball game, whole different set of questions to ask AI later on that we'll go through. But yeah, you really do need about 5,000 in funds to get the ball rolling. And that's just basic stuff. 5,000 is including LLC. You're going to need a website, some sort of social media activity, some sort of CRM, customer relationship management, that you can manage your deal flow or manage your contacts and your marketing. And then you're going to need some due diligence costs on the front end for BPOs or inspections, title reports. A lot of stuff can be returned to you when you do close on the official one, but you're going to need a little bit of upfront money on the front end side for due diligence. If you don't have any of your own money, don't stress out. We've helped thousands of investors raise capital and go buy notes and pay their investors an underlying great return while they're making the difference. And it's a win-win. Okay. Number 3, what are the potential returns with note investing? This is always a question I get. Returns can vary based on several factors, including the interest rate on the note, the loan to value ratio, and the overall risk profile of the investment. Generally, note investments can offer returns ranging from 6 to 12% or even higher, potentially exceeding traditional investment options like bonds or CDs. Okay, here's the thing. I've never bought a note where I didn't beat a bond or a certificate of disappointment. Okay. However, remember, higher potential returns often comes with higher risk. That's the first sentence I really objected to. Yes, in most cases, the higher the risk or the higher the return often accomplishes the higher the risk, but that's not always the case. I've got a student, Phil, right now, made an offer on a first lien for 17 grand. The guy owes like 50 grand. It's almost a 30% cash and cash return, and he's in a first lien position. He's buying the note at a discount. So oftentimes, if you're buying notes, the higher the risk, the higher the return, the lower the risk if you're buying it for your own stuff. I don't take that as a patent, rubber stamp across everything, but oftentimes the higher the risk or the higher the return, the lower the risk it is for notes versus buying and flipping property or, doing some private lending or other things out there as well. Okay. 4, do I need a real estate license to invest in notes? In most cases, a real estate license is not required for note investing. However, regulations might differ by state, so it's always a good idea to check with your local authorities or consult a financial advisor familiar with note investing laws in your area. I don't know why they keep referring to a financial advisor, but I found that out throughout this. Financial advisors most of the time don't have a clue about note investing. How do I know? Because I used to be one. I've talked to enough financial advisors, though, they don't have a clue. So don't follow that, okay? It's important to talk with somebody familiar with note investing, like a real estate investor would be better, but not a financial advisor. Going back to the licensing question, some states require you to have a mortgage broker's license, like Georgia. Others want you to be a licensed debt collector out there. States like Washington State, Oregon State are a little bit more, want you to have a specific note buyer's license up there. California, if you're going to buy California notes and you live in California and you're selling to California, they want you to have a real estate license there in California. Just their pound of flesh. Okay. But here's a way to get around it. Most of the time, if you've got a servicing company, a third-party company that's collecting payments on your behalf, and you need to have one of these, they're going to often be licensed in the states that you're buying notes in, and their debt collector's license will often cover your licensing requirements most of the time. There's a few exceptions, and we can talk about that later on, depending on the states. Okay. Number 5, where can I find notes to invest? The $1 million question. Okay. Note brokers was the first thing they popped up. I really dislike that. These specialized firms connect investors with note sellers. They typically charge a fee for their services. Yes, they do. But that's not the first place I would go to, because oftentimes people call themselves brokers and they're really joker brokers who are just throwing stuff against the wall. Online marketplaces. This is not so bad. Several online platforms facilitate note investing by connecting buyers and sellers. There's not a true multiple listing service or an MLS for notes like there is for real estate. Okay. Real estate investment groups, REITs. Some real estate investment groups specialize in note investing and offer opportunities to their members. That's true. You have to be careful in some of these groups. I've seen some very good ones. I've seen some very unethical real estate groups. Direct lending. You can also potentially find notes through private lenders or by attending real estate investment conferences. That's correct. You can find some stuff there. What they left off was where you're going to see most of the mortgage notes that you can buy from banks, mortgage companies, and hedge funds, of which we've hung our hat on over the last 18 plus or 16 plus years by going direct. And yes, banks and mortgage companies will sell you notes if you know what to say and what not to say. doing these other 3 or 4 things is not bad. But you're going to be very limited and unhappy and not have a lot of steady deal flow. Don't get me wrong. I buy from some brokers. All right. But I'm also not selling to a broker. I get brokers all the time. Hey, can you send me your list? I'm like, no, I'm not going to do that because I'm only going to deal with direct sellers. That's one thing mortgage companies and note sellers want to deal with is the direct buyer, not going through 1, 2, or 3 brokers along the way. Now we started getting some nitty-gritty questions. What's the principal balance of the note? Now, the principal balance, this is the remaining unpaid amount of the original loan that the borrower owes. When you invest in a note, you are essentially purchasing the right to collect this remaining principal balance along with the interest payments over time. It's known as the unpaid principal balance. UPB is a common term you'll see. With non-performing notes, you will also have the right to collect on the full legal balance of the note, late fees, back payments, any lender advance fees that the previous lender has bought in advance. Those are all in the payoff amount of what's due. All right. But the principal balance of the note is usually what you're targeting along if you're buying non-performing, any back payments and stuff like that. Now, what's the interest rate of the loan? Pretty simple. This is the annual percentage rate, the APR that the borrower pays in a loan. The interest rate you earn on your investment is directly tied to the interest rate on the note. Buying at a discount, you're going to get a higher return than the interest rate. A shorter time frame, if you buy at a discount and the borrower pays you off before the term is up, you get a payoff in higher APR. Is the borrower current on their payments? Where this kind of it changed in the kind of the questions. Is the borrower current on their payments? This is crucial information. You want to invest in notes where the borrower has a good track record of making timely payments. Yes, most of the time. Most sellers will provide documentation on the borrower's payment history during the due diligence process. If they do not provide payment history, do not close on the deal. Okay. This is why a third-party servicing company is so critical, because this is one of the things we'll ask, hey, can you provide the payment history and updated payoffs? If you're buying from just a note seller who doesn't have it with a third party, they're self-servicing, you may not get a very accurate payment history, and that is not a good thing. Knowing the payment history of the borrower also helps determine the discount or purchase price of the performing or non-performing note, especially non-performing where somebody hasn't been paying on time. Depending on how far behind, that will determine your discount, depending on how far behind they are compared to the legal balance, to the market value. There's a lot of things that go into that, but it is always important to look at the payment history of the note. You need to have that. It's got to have that with a servicing company. If you don't have an accurate payment history, they can't provide it. Do not pay full value for the deal. Trust but verify, you'll hear us say that. Oh, I trust you, but I want verification that they've done that. What is the term of the note? Another kind of nitty-gritty. The term, this refers to the length of time the borrower has to repay the loan. In full, notes can have varying terms ranging from a few months, like 6 months or 12 months for hard money loans, to several years, 30-year mortgage, 40-year mortgage, even 50-year mortgages. We've seen some things modified to that. You also see some balloon payments where a large portion of the principal becomes due at the end of the term. You may have like a 10-30, 10-20. That means that the mortgage is amortized over 20 or 30-year loan period, but they've got a balloon payment due in 10 years. So whatever is due in 10 years is due at that time. And you'll see a lot of that in the commercial space. It may be a 30-year amortization with a 5-year balloon. Okay. Balloons aren't as popular as they used to be years ago, but you'll still see those occasionally. What is also important is the remaining term of the note. This is important if you're buying like a 30-year mortgage or a 20-year mortgage note. More interest, more profit is paid on the front half of the note versus the back half of the note. Okay. In the back half of the note, more principal is paid than interest. So it's writing down your principal quite a bit. So it's less profit margin. So keep that in mind. It's always good to be buying on the front half of the notes instead of the back half of them. If it's on the back half, you need to discount your offering because that principal is getting paid down faster. Number 10, does the note have any guarantees or endorsements? Well, this is why we only buy notes on residential. Some notes might have additional security features, like a guarantee from a third party who agrees to make payments if the borrower defaults. Now, here's something. Many of the federal loans, the Fannie, Freddie Macs, they have guarantees on them where if the borrower stops paying and the bank has to foreclose, the bank will come in or the government will come in and pay off what's remaining. Okay. Additionally, an endorsement might exist where another party co-signs a note, increasing your potential for recovering funds in case of a default, like a co-borrower. Sometimes you'll see where it's a husband and wife or two brothers own a property or the co-borrower. You have to be careful about where it's more than like 3 or 4 people, because when there's more guarantors on the note, it can also lead to delaying it through bankruptcy, delaying it out because of legal issues that anyone could throw up there. I've had that happen before, so keep that in mind. The note also keep in mind that it might also be cross-collateralized with other real estate assets. Or you might be able to attach liens to other real estate owned by the borrower if you're unable to collect during the foreclosure process, if it's non-performing. So like if I'm buying a note on a property that's a rental property and the borrower's not paying, I will look to see if the borrower or the LLC that is the signer on it, the guarantor on it, has any other real estate. Because if I foreclose on investment property and I don't get full payoff, I can go after a deficiency judgment and throw that against all their properties to make sure I get paid. So it's a bargaining chip to help out with that. So keep that in mind. Look through the mortgage, see what any endorsements, guarantees, stuff like that. Personal, non-recourse loans. Those are like hard money loans where it's just the property is the only recourse you have to take the property back, not to go after the borrower. 11, what happens if the borrower defaults the loan? One of my favorite things, right? If the borrower stops making payments, you have the right to foreclose on the property. This is a legal process that allows you to take ownership of the property, recoup your investment. However, foreclosure can be time-consuming and costly, so it's important to factor in this potential risk when evaluating a note investment. Very true, okay? What you have to keep in mind is that states usually have one of two foreclosure process. Sometimes a few states have both. Like California has both a judicial and a non-judicial foreclosure. If it's an owner-occupant home, a homestead, it's going to be a judicial foreclosure, which means you have to go through the judge court system. A non-judicial foreclosure is fast, where all you have to do is file and publicize that you're getting ready to foreclose. And that publication is all dependent on each state's time frame. All right. So like a judicial foreclosure is going to be usually at least 6 months to up to 3 years, depending on what state it's in, like New York, New Jersey's 2 years. Unless it's vacant, then it can be 6 months. But Puerto Rico can be like 3 years versus non-judicial states, which can be like 1 to 6 months, like fastest being Texas. Georgia's the second fastest, Missouri, Tennessee, and the non-judicial states are like 4 to 6 months in a lot of cases. Okay. Now the cost of that too, non-judicial is cheaper, $1,000, $1,500 to $2,500, depending on where it's at. Judicial is going to probably run you $3,500 to $10,000, depending on the asset and depending on what type of delays. If you've got a distressed borrower who's trying to drag this out, you can run into some delays with delaying the foreclosure. Court proceedings been delayed, bankruptcy, all sorts of great things. So keep that in mind. Not against judicial foreclosures, but just keep that in mind that you're going to have some inherent risk of buying judicial foreclosures. You want to kind of hedge against that and pay a little cheaper for those versus a non-judicial foreclosure. 12, what are the costs associated with loan servicing? Pretty simple. There might be fees associated with servicing loans, such as collecting payments, handling other delinquencies, and potentially managing the property if foreclosed becomes necessary. These servicing costs can be deducted from the borrower's payments you receive, impacting your overall return. Some investors choose to self-service their notes while others utilize third-party servicing companies for a fee. Okay, let me state this right now. You should never self-service a loan. Hire a third-party servicer to do it. That's what they're for 25 to 95 bucks a month, 25 to 35 on average for a performing note, 95 a month on average for a non-performing note. It's well worth it. If those costs are too much, 25 to 95 dollars a month are too much for you, then don't do the deal. Don't buy the note. This is why we look at notes that have a monthly payment of at least $250 to $300 a month on average, or not on average, but at least that is a minimum amount. Anything below that, it's really hard to make any money on. You're going to have foreclosure costs, you're going to have servicing costs, and then your servicing companies also going to have all sorts of a la carte fees, like door knocking fees, property inspections. If you were able to work on a payment plan or a loan modification, there's going to be some costs associated with that as well. Don't forget about paying insurance, forced place insurance, and also taxes as well. You may have to advance taxes as well as part of your servicing company. Okay. What type of property is securing a note? This is a good question. The type of property, single-family home, multi-unit building, commercial property, can influence the risk profile of the investment. Understanding the property type and its market conditions allows you to assess factors like potential vacancy rates or ease of resale in case of foreclosure. It's all right. First liens are in the senior position. That's where you want to be. You want to buy a first lien only. Junior second liens are in a more riskier position due to their position behind the first lien that you foreclose. If you own a first lien and there's a second lien behind you or junior lien and you foreclose, you can wipe out that second lien. You also can get wiped out if the taxes aren't paid and tax foreclosure takes place. Okay. You always want to make sure that you're buying the note at or below the property value and never above the property value. Okay. So let's keep that in mind. And obviously, residential loans are going to be different than your commercial loans, especially right now. You have to understand interest rates are different. Foreclosure timeframes are different states. Costs, I mean, there's a lot of multifamily or apartments that are going to foreclosure right now because they weren't financed properly. So really understand the asset class. You can't, it's not a vanilla type of rubber stamp due diligence across a condo to a single family to an apartment. Okay. You also have to understand there's different costs associated with condos than there are single family homes. You got to know the foreclosure timeframe, what's going on in the markets. Eviction timeframes is very important. So keep that in mind. It's also important to know where your property is located. You don't necessarily want to buy a rural property where there's nobody around to go out there and help you and due diligence or buyers or less. So always try to stick to property, especially when you're starting off into markets that at least have 50,000 or greater. I mean, you can go down from there a little bit, but something you have knowledge about, and there's plenty of resources for you as far as professionals, rehabbers, attorneys, realtors, door knockers, that kind of stuff is important. Okay. Number 14, kind of basic, but it asks, this is the top 20. What is the fair market value of the property that is securing the note? Knowing the fair market value of the property is crucial for several reasons in note investing. The loan to value. This ratio compares the loan amount, outstanding principal balance of the note, to the fair market value of the property. A higher loan to value ratio indicates a greater risk for the investor. It means you're basically paying for the note what the property is worth, or that the note was financed at a higher percentage of the true value of the property. If the borrower defaults and you have to foreclose, a property with a high LTV might not sell for enough to cover the remaining loan balance or to cover your foreclosure costs. Okay. How do you value a property? Well, you're going to use appraisals. Not really for the most part. You're going to use online evaluation tools on the front end, some market tools like a NAR, RPR, realtor report. You're going to get a realtor to pull a CMA for you, or we call something called a broker price opinion, a BPO. It's not an appraisal. A broker price opinion is getting a realtor to drive by the property. They can't get into it like an appraisal would need. And after they see the property, they're going to go pull numbers and give you some ideas as far as comps. Number 15, as we roll into the home stretch. What is your investment strategy for note investing? There are several investment strategies in note investing. Here are the few common approaches. Cash flow. Focus on notes with attractive interest rates that generate steady monthly income through the borrower's payments. Passive income. Invest in performing notes with established payment histories for a more hands-off approach to generating passive income. This is a great strategy. Cash flow is great, but if you're working too much and you got an IRA and you don't want to do a lot of workouts, you don't want to foreclose, passive income by buying performing notes or investing in note funds would be a good thing for you. Flipping notes. Purchase notes at a discount. Notice it didn't say wholesaling notes. Okay. Purchase notes at a discount, potentially due to a temporary hardship for the borrower, and then resell them at a profit to another investor. The strategy requires more active management, involves a higher risk profile. I wouldn't say it involves a higher risk profile. It's just going to be more work, knowing what you're getting, knowing the deal return, and then also being able to market that deal to potential buyers who are looking for stuff. I threw an asset growth in here. I know asset growth shouldn't be your primary investment strategy, but it's still going to be sometimes what's going to end up happening, especially if you're buying like reverse mortgages and other things like that. You'll sometimes purchase non-performing notes with the sole intent of foreclosing to either sell the asset at the foreclosure auction to make a profit because you're buying at a discount, or take the property back as an REO or as a real estate owner. And then what you do once you foreclose, that's up to you. Fix it up, sell it, rent it, owner finance it, dance a jig in it, whatever you want to do. You can do that as asset growth. I know some people that try to do that in specific markets where they own real estate already. It's a different strategy than being a renter or being a landlord. You got to keep that in mind. So note investing is different than your traditional real estate investment strategy. So you have to keep that in mind. I've seen a lot of real estate investors try to get in the note list without being educated and understanding the thing, and they end up paying too much for notes that they end up losing money. Right? It's not the same thing. 16, what is your risk tolerance for note investing? This is a very important question. Your risk factors. Note investing involves inherent risk like borrower defaults or property value declines. Assess your risk tolerance to determine suitable investments. Investors with a lower risk tolerance might prefer notes with a strong borrower profile, like lower LTV ratios, and government backing like FHA loans. Okay, you're not going to be able to go out and buy an FHA loan. I'm going to tell you that right now. You're not going to go out and buy a Fannie or Freddie Mac loan 99.9% of the time. Only occasionally will you see those types of things out there, and they're usually going to be non-performing notes, okay? You're not going to go buy a performing FHA loan, a VA loan, or traditional 30-year mortgage from Chase, Citibank, Wells Fargo. Just not going to happen, ladies and gentlemen. I'm sorry, okay? You also need to keep in mind foreclosure and eviction timeframes. This is me throwing a little bit into it. Property taxes, insurance costs, and market conditions such as days on market and potential rehab costs, okay? We'll want to limit your risk depending on your own tolerance and comfort level in real estate. You don't want to be going, you're buying a vacant house out in the middle of nowhere. You don't want to try to rehab a property halfway across the country. That's not a good position to be in unless you've done it many times before. Okay. Start off small, start off with maybe occupied assets that were not performing and now they're reperforming. That would be a good starting point to get your feet wet. Start in your local market if there's plenty of inventory. There are some states that don't have any inventory or the buying process just doesn't make sense. So keep that in mind. Worst case, jump on a Southwest Airlines flight, fly across the country to learn more about that market. Number 17, how will you diversify your note portfolio? I like seeing these questions. It's just kind of funny. Their answer for this was diversification is key to mitigating risks. Spread your investments across different note types, performing versus non-performing, long-term, short-term versus long-term, property types, residential versus commercial, and geographic locations. That is the worst freaking answer I've ever seen, okay? I'm going to go back to it in a second here. Your risk tolerance will also play a critical role in your portfolio. If you want passive returns, then investing in performing notes is the right niche for you. Yes, you can buy performing notes, owner finance notes, not bank notes, usually. If you want to be more hands-on with the potential for high returns, then you might want to consider non-performing notes. Residential notes are a great place to get started. Commercial notes take more money, more time, and specific due diligence and market knowledge than when compared to residential notes. Okay, huge thing here. You're not going to have a note portfolio have like one residential note and one big commercial note. Just doesn't work that way, ladies and gentlemen. I'm sorry. Yes, performing versus non-performing, but you have to keep in mind, if you're a passive investor and you don't want to get into it, don't go out buying non-performing notes. Understand your buy box and stick to your buy box. Single family homes, 1,000 square feet above, from 100 grand to $500,000. Okay. In judicial and non-judicial states that have a 12-month or less foreclosure time frame would be good for you. Okay. And what is your exit strategy for note investments? This was kind of a funny answer too. Plan your exit strategy beforehand. Common options include, and let me tell you this. This is one of the biggest bad answers I've seen. Holding to maturity, collect principal and interest payments until the loan is paid off. That sounds great, ladies and gentlemen. But we all know that majority of people will move every 7 to 10 years. You're rarely going to hold a note for 30 years, okay? This is AI talking, meaning they've never done it, okay? Selling the note. Sell the note on the secondary market to another investor, potentially at a premium if the interest rate is attractive. Yes, you could do that. You could buy notes, get them reperforming, and sell them on the secondary market. Or you could buy non-performing notes and sell them back to banks. Done that. I like that one, okay? The holding maturity was a bunch of crap. And the idea here is, yes, you can kind of plan your strategy to hope for and reduce your risk by doing your due diligence. But I've had non-performing notes that I thought I was going to foreclose on that became reperforming. Same thing. I've had performing notes that turned non-performing that I had to foreclose on. So you're going to have to be a little flexible in having 1, 2, or 3 strategies. Foreclosure. This is the last resort, but the borrower defaults. You can foreclose and take ownership of the property to sell it or generate rental income. Yeah, you can sell it, keep it. But here's the thing. In some cases, it is not the last resort. It's the only resort. If a borrower has not paid in longer than 2 years, you're probably going to foreclose, especially if they stop paying before COVID in 2020. Guess what? You're going to foreclose on that sucker most of the time, okay? If it's a vacant asset, you're going to foreclose, get a deed loan. There's a whole variety of process of it. This is one of the most important strategies. Important things you need to know is a waterfall event of which way you want the X to go, and it's not always in your control, okay? The borrower has the money to reinstate the loan. Guess what? They have the right to reinstate the loan. Buying a non-performing note at a discount, getting it back to performing status, and holding it for cash flow, and then selling it for a profit to the market. That's my favorite strategy. Higher returns. You've got more income, more assets to choose from than most of your traditional people at better prices. Okay. You can also purchase a note partial. I know, I can't believe I said this, but you can also buy a partial of a note where you're buying 12 to 60 months of the payment stream at a discount. So like we've got a friend who will pay 10 months for 12 months of payments, and he's always going to get about a 20% return on his partials. He likes the little partials. I'll give you 10 months of payments for 12 months of payments. And you would set this up with a third-party servicer. So those payments come in for a year. They go to Tom. After 12 months, it goes back to you. Okay. 19, what are the benefits of using a note broker? Not many. AI said note brokers can offer several benefits. Access to a wider range of notes. Brokers have connections with sellers and can help you find suitable investment opportunities. That's true. Some of them do have sources that will send stuff out to you on a regular basis. Due diligence assistance. Brokers can help evaluate notes, analyze risk, and provide insights into the borrower and the property. No. Most brokers will not help you with due diligence. They'll not help you analyze the risks, okay? That's buyer beware, okay? They might give you some insight into the borrower and the property if they're truly selling on their behalf. But that would be a note seller, not a note broker. Most brokers want to stay very neutral. You know, if a broker works for a bank or a fund, that's a seller. That's not a broker. Okay. Streamline transaction process. Brokers can handle paperwork and facilitate communication between you and the seller. I hate this. I want the broker to get the heck out of the way so I can communicate directly. I can get answers faster that way. All right. If you're not getting answers fast enough from a broker, you're probably part of a daisy chain, and that broker is a joker broker, not a real broker. Fees, here's the thing. You, the seller, or both may be paying a commission to the broker. The broker should disclose this on the front end. We have one broker that charges 1.5% of every transaction funded. That's the funding amount. So if we're buying a note, 100 grand, he's going to get $1,500 fee. It's 1.5 points. Others, when we sell notes, we'll broker do a flat fee, 1 to 3 points of the funding amount, depending on what's going on. Okay. Do not mistake a note broker for a note wholesaler. I had a guy call me today. Hey, do you have any notes for sale? What are you buying? We have some stuff. I'm like, danger, Will Robinson, danger. That sounds like a note wholesaler. And sure enough, when somebody asks, we buy anything, what do you buy? I'm like, I don't want to deal with that for the most part. I'm working very hard for my sources at banks, hedge funds, investment companies, insurance companies, all that stuff. I'm not going to give away my deals. You should always be buying for your own investment portfolio first, ladies and gentlemen, not being a broker. I'm sorry, but note brokers and wholesalers, people want to get into that because there's no investment on their part because they don't have any capital. Guess what? You got to learn to market, and guess what you have to do if you're going to market? Raise capital. So you might as well raise capital first and not be just a note broker to make the least amount on a deal. Okay. Number 20, the final kicker. What resources are available to learn more about note investing? I didn't write it. They did. And it was lacking as always. There are numerous resources to educate yourself on note investing. Books, several books delve into note investing strategies and best practices. I'm sorry, but there are some great books out there in owner financing and structured stuff, but most of them are outdated. The market's changed. The market is always constantly changing. Okay. Online courses, educational platforms offer courses specifically focused on note investing. That's true. If you're going to be buying an educational course, make sure it's from somebody who's closed on deals, is still closing on deals. You can go to weclosenotes.com. That's my website. Or noteweekend.com. That's my one-day course. That's free for you to get started. Those are great places to get started for you. Investment clubs and conferences. Networking with experienced note investors can provide valuable knowledge and insights. Yes. I often find there's a lot of investment clubs. There's a lot of people that want to do something, but they're not doing something. Conferences are great, but there's also a lot of people there's a lot of talk about doing something, but often not a lot going on. All right. Websites and blogs. Many websites and blogs offer articles, guides, and information on note investing. That's the same. I agree. You can find some information, but also a lot of these things are outdated. Don't trust what's just on the internet. Talk to other people, cross-reference information, ask questions. There's no dumb questions asked, okay? If you want to find out a lot of information, we've got the #1 YouTube channel at weclosenotes.tv and also the #1 podcast at the Note Closer Show podcast. Hopefully you're listening or watching on one of those two resources right now. Remember, getting educated, conducting thorough research, and due diligence is crucial before investing in any note. Consider consulting, and they said this, with a financial advisor. No. Consider consulting with an advisor or hiring a coach familiar with note investing to ensure it aligns with your financial goals and risk tolerance. Can go a long way to achieving success faster. Go get you a coach. Go find somebody who is where you want to be, is doing what you want to be doing, and ask them. Some of the most successful people are the most giving their time, and we're here to help you, ladies and gentlemen. So that's the 20 questions according to AI. Like I said, about 60 to 70% of it wasn't too bad, but there's a big chunk of that 30-40%. It just left a lot to be lacking. Some more research for you guys. Like I said, go to the Note Closer Show podcast. Go to our website at weekclosenotes.com, or you can always book a call with me. Yes, this is my schedule, or this is my calendar link, talkwithscottcarson.com. That's talkwithscottcarson.com. Book a call with me. I'll give you 30 minutes. You can pick my brain. Just don't ask me these same damn questions off of AI. Go out there, take some action, ladies and gentlemen, and we do look forward to seeing you to the top. It's a great note investing is a great strategy. It's you can do this 10, 15 hours a week. You don't need to be full-time. You can do this in passive level. You don't have to have a lot of capital. A lot of great opportunities out there, ladies and gentlemen. We've helped thousands of other real estate investors, both new and seasoned investors, dive into the sexy side of real estate or become a note investor. We'll see you later, everybody.